All right, welcome to Freyman CPA's Vehicle Deduction Workshop. So today I'm going to discuss with you vehicle deductions and the best way to put it through for your business. Now, the vehicle is actually quite complicated because for tax purposes we have two methods of accounting for the vehicle, and we have the actual expense method and the standard mile method. So as the description implies, the actual expense method just basically deals with counting up all the actual expenses and receiving a deduction for all the actual expenses, and those would include the cost of the vehicle. For example, maybe lease payments, all right, gas, tolls, insurance, maintenance, right? So we said maintenance, repairs, maybe washing. That's kind of like maintenance. So anyway, all the actual expenses would need to be tallied up. And so you would have like a dollar value here, dollar value, dollar value, dollar value. Then you would add it all up. All right. And you would take the total miles driven. Then you take the business miles. You get a percent, and then you multiply that percent by the total dollar value. So if this is $100 worth of total expenses and you drive the vehicle 80% of the time for business, you would get $80 worth of deduction. As you can tell, this is very cumbersome. It takes a lot of accounting to do, and most of the time people don't want to deal with it. And it also has tax consequences because of the cost of the vehicle. Obviously, if we're dealing with lease payments, that's something different. So let's dive in a little bit into what the actual expense method really means. And there's really a lot of avenues when it comes to the vehicle deduction. That was my joke for the day. So when we're dealing with actual expenses and you own the vehicle, or you're financing the vehicle, you get to claim depreciation. Depreciation expense is you're basically deducting, or rather depreciating the vehicle based off of some sort of methodology. Typically it's a prescribed methodology, and we're going to depreciate the purchase price of that vehicle. So if you own it outright and you bought it for, let's say, $15,000, it would be the same as if you financed the vehicle for $15,000. And you haven't, here you've already paid the money, you paid it outright. Here you're still paying it every year. Year 1, year 2, year 3, but you're on the hook for this. So you can take the depreciation as if you already paid for it outright and you haven't laid out any cash. That's actually a tax strategy. So you can go out December 31, buy yourself a vehicle and finance it in full, not spend more than like zero down, and you're on the hook for that vehicle. You can actually take a full deduction on that vehicle if all the cards are playing out right. You can take a Section 179 deduction and really max out your deductions and just wipe out all the cost of that vehicle in one fall swoop. That's up to you. There's different methods of depreciation. So like I just mentioned, you have Section 179 deduction method, which is basically allowing you to write off the entire vehicle or part of the vehicle. That choice is up to you, how much Section 179 you'd like to take. There are limitations as to the value that you can take. For most people it won't apply. We're talking small business here. We're not talking you went out and bought a fleet of trucks. Obviously there's limitations on a federal level for the Section 179, and there's also state limitations. So just tread carefully. Here I'm discussing federal tax law. I'm not going to go into state tax laws because those will get very complicated very quickly and things will vary. So let's just focus on federal taxation. When I mean federal taxation, I mean IRS tax rules. And so basically you can take the Section 179, or you can take what we call a prescribed method of depreciation. And a prescribed method of depreciation is a slower cost recovery system. It's not as accelerated as Section 179. There's also bonus, which is new. That's not an everyday type of deduction either. That's around for only a certain number of years, and then eventually they'll get rid of it. But they all have like different limitations, what you can deduct. You know, Section 179, bonus, they're really for, you know, multiple types of assets. It's not just for a vehicle. So just to understand that. A prescribed method really is prescribed. It looks, the IRS has asset types, right, that assets fall under. So if you have a building, or you have an auto, or you have furniture, so the IRS already has these as prescribed, and depending on the type of asset you have, it will have to fall under that specific type of asset, and that specific type of asset will be depreciated over a certain amount of prescribed years, depending on the business use or asset type. It will actually have different useful lives that the IRS will determine that it should be depreciated under, and they don't always make sense. You know, so like a building for example, for rental property is 27.5-year depreciation, but for commercial it's 39, right? For foreign it could be 40. So they don't necessarily always make sense, but that's just, you know, that's just how it works. So if you take the prescribed method for a business use vehicle, you're looking at typically a 5-year life. Not always, because if it's a luxury vehicle, then luxury limitations apply, and that vehicle might be deducted for much longer than 5 years, depending on how much you're using it for business purposes. So that's why it gets very complicated very quickly, and you know, navigating, no pun intended, the auto deductions is quite complicated, and you really need to have somebody that's well versed in taxation, that has many years of experience dealing with automobile deductions, to really get the most out of it and really watch out, help you watch out for a lot of the pitfalls. So let's talk about some of the pitfalls of using the actual, well, before we do that, let's talk about the depreciation a little bit more. So when we're depreciating the asset, again, we're taking, let's say it's you know, purchased outright or financed, whatever, $15,000, and you're depreciating it. Let's just say you depreciated $10,000 off of the value of this vehicle that you purchased, right? I should rather say purchased. What, you know, so when you buy the vehicle, if you purchased it or you financed it, you have what we call as basis. That, for tax language, really means that's your basis. That's what you paid for. That's your cost. I don't care if you drive it off the lot tomorrow and it drops in value and you can't resell it for $15,000, and all you can resell it for is $7.5 because it dropped in value because it's no longer new. That doesn't matter for tax law. For tax law, what you paid is your basis. That doesn't change. What does change is the depreciation. So as you're claiming depreciation, or what we call cost recovery, you're actually deducting the basis every time. So if I were to buy this vehicle in year one, and in year one I claim depreciation on my taxes for $10,000, I just received a deduction for this asset for $10,000. In my hands, this asset is now worth $5,000. So this is my new, what we call adjusted basis. Adjusted basis. So if I were to sell this tomorrow, basically, right, even though I can get, let's say, $7,000 for this vehicle tomorrow, in my hands it's worth $5,000 for tax purposes. even though it hasn't depreciated that, maybe I drove it off the lot and I can resell it for $7,000, right? But since I already deducted it, in my hands, it's worth $5,000. So unfortunately, I'm going to trigger a $2,000 gain in a very simplified language. Okay, so this is the gist of it. This is what you're doing when you're depreciating the vehicle. So what's the pros and cons of all of this? So what does all of this mean? All right, let's look at the actual expense method, and what are some pros? So pros to using this method: you can get a lot of deduction in 1 year. So that's definitely a pro. All right. What would be another pro for the actual expense method? It can match the true nature of the vehicle. What does that mean? Well, if I'm using my vehicle greatly for business, let's say it's a workhorse. Like, for example, I have a flower delivery business and I buy this van. It's an old beat up van. And all it does is deliver flowers. It does nothing else. Matter of fact, before I went to college, I drove one of those. It was the ugliest, worst thing on the planet. Nothing worked on it. When I was a kid, I had to get up in the morning, like 5 in the morning. I had to stick my fingers into the carburetor and kind of like resuscitate it so it would start. It was dead winter, and I had to bust open the console and perform like surgery on this car so that it would start. It was ancient, and that's just the story of mine. And then it would start up, and then it would drive. It would be cold, and my fingers would hurt from getting the carburetor open. And then it would actually stop on every light, and it would have to like go through this again and again until it warmed up like 4 to 10 blocks down the road. Nothing worked in it, like the lights needed tape, and the window was held up with a screwdriver. The tires needed air every other day. If it rained, I had to change the tape on the blinkers in the back because there was no glass covering the brake lights. It was just a mess, But you buy something like that, you're not exactly going to take that car out on a date. You're not exactly going to use that car for anything but driving to work, to deliver the flowers. I used to get up at 5 in the morning, go to JFK, and pick up like tons of flowers for a flower shop. And then I would bring it to the flower shop, unload it, and then they would give me deliveries, and I would take all these flowers over to all these different local flower shops. Angie would get some flowers too out of the whole deal. But that's many years ago. That's way before college. And so that, that kind of vehicle, you're not going to use for personal purposes. So that kind of vehicle is great for actual expenses because there's really no other, what's that? There's no personal use in it. So I can just literally put through all the expenses directly in my business and not have to worry about any other item, right? So it's very simple, and it's a workhorse, and that's an example of a vehicle that's perfect for the actual expense method. So that's another pro. It matches the true nature of the vehicle's business use for workhorse type. So, and that could be a food truck. That could be somebody's truck that they use exclusively for business. As far as other pros, I honestly cannot think of any, because that's it. Now let's look at the cons, which you'll notice there's a lot more cons. So this method is really typically best used for somebody else, for like that work situation. Most people, your consultants, anybody that's using that vehicle for 80% and above, that's a great type of way to go, but not always. Not always. All right, so let's look at the cons. Okay, cons. 1, potential tax gain on disposal. 2, cumbersome. Now, I don't know if I spelled cumbersome correctly, Ange. That's right. Check, check, check for spelling. All right. So very cumbersome accounting method. Like I said, you have to keep track of your miles. You have to account for all the expenses, and then you can take the deduction. So it's cumbersome. So let's see. Other cons. So we said partial tax gain on disposal. You're stuck with it. Stuck with method. If so started. So if you started on this method, you cannot switch over. You can't go back to standard miles. But if you start with the standard miles method, you can convert over. All right. May produce small deductions in the future. You might say, what? I thought that this was supposed to give me, the biggest bang for my buck. You just said, Greg, that it produces great deductions. Yes, it does. But what happens when you write off the depreciation? So year 1, let's say you take the prescribed method, and year 2, year 3, year 4, and then year 5, you're going to write off that what's the biggest cost you got? And I'm not talking about a really old beat up truck that's going to take up a ton of expenses. You're going to write off the whole thing, right? You're going to write off the depreciation. That's the biggest deduction. The oil, the gas, the insurance, the maintenance, all that other stuff is kind of like, it's not a huge expense. Again, I'm not talking about a very old truck like in my story where it needs a ton of maintenance. You got yourself a decent car. It could be slightly used. It could be brand new. You're not going to need to maintain this thing that much in the first 5 years. And imagine you actually deduct the whole thing in year 1. What's going to happen if you deduct the whole thing in year 1? You used up all your depreciation. You're going to have very little to no deductions compared to the standard miles, vis-a-vis standard miles. And the standard miles are just going to keep going and going and going into as long as you use this method. So if from our experience, when you start comparing it over the long haul, your standard mile method is going to produce way more deductions for you than the actual expense method, especially if you write it off in year 1. Or if you're not using that vehicle that much in business. So if you have a luxury vehicle, you think you're smart, and you're working some sort of consulting job, or you're not using the vehicle too much, I don't know, maybe you're a real estate agent or something like that, and you take and you have a luxury vehicle, and even though you're using it 80%, it has limitations. So the depreciation might go on for 15 years. You won't really benefit much, but the first couple of years, and then you're left again with very few deductions. So again, the concept here is may produce small deductions in the future compared to the standard mile method. All right, and you're stuck with it. And you have all this cumbersome accounting that you need to do, and you have to keep going with it. So those are basically the cons. So as you can see, for most people, this is probably not going to work. I'm sure there's probably other reasons that don't come to me at this moment as far as cons against the actual expense method, but that's the majority of it. And again, here's another one. If you use the vehicle personally and you moved the vehicle into your business, so your business owns the vehicle, then any personal use is subject to income tax and would be reported on your W-2. So that holds true if you take your personally owned vehicle and then you move it into your business and then you're using it for personal reasons. So don't do that, folks. All right. Anyway, so that's the cons of the actual expense method. Again, you're welcome to use this method if you like. let's talk about the standard miles, and there's really very little to talk about. This is just simply 55 cents per mile, or 56 cents per mile, or whatever mileage you have for that year. I don't know what this year's mileage, standard mileage rate is. It changes every year. It's very simple. You basically, you have an app like Mile IQ or comparable. You get in your car, you swipe it for business, and then you're good to go. You have your accounting. It's all audit-proof. You use that for your standard miles. And this can very easy to use, very simple method, very straightforward. And like I said, it might produce a lot more deduction for many people over the long haul. And a lot of our business owners use it. All right, how to put it through? Well, that's the tricky part. If I'm a sole prop or single member LLC, it's actually quite easy to put through this vehicle. You don't do anything. You do all the accounting on your Schedule C, which is profit and loss from business, on your federal form 1040. You fill out a worksheet, which is going to ask you for actual or standard, and you're going to figure out which one you like to use best. And you can gather up all your expenses and see if this one produces a better deduction for you or this one, and then hopefully you have a little bit of foresight and you can kind of figure out, well, that's what you pay us to do, but if you pick the wrong one, you're stuck with it, and so on and so forth. There's also other, once you start with certain methods, if the percent of business use falls below 50, it could also trigger tax consequences. That's another con I forgot to mention. I think that might actually apply to both methods. Now, so very simple accounting, one way or another. You can figure out your actual expenses. Where the problems start is when you have a business that's not a Schedule C, not a disregarded entity, when you're dealing with a corporation, when you're dealing with a corp, whether it's a S Corp or a C Corp, or an LLC that is taxed as an S or C Corp. When you have this, you are no longer dealing with the informalities of deductions the same way you do as with an LLC that's a single member LLC, or a sole proprietor, somebody that's not incorporated, or being taxed as a corporation. Once you have this set up, like I said in other videos, and I'll say it again, you have more formalities. And that's the problem with the corporate entity. Many people act like if their corporation and them are one, and it's really not. You have to go through a formality of reimbursement. So you cannot just put through all your your vehicle is your personally owned vehicle. So if I put the deductions of my personally owned vehicle, it'd be the same as my company paying for my home too. That's legally mine. My corporation is a separate legal entity. It's just like, it would be the same as me paying for your deductions and trying to recoup the costs on my business. This is not my legal liability. I have no obligation to do that. So you might ask, well, how do we put through all of this then through a corp? Well, with a corporation, it's very much like when you work for someone, and I know when I worked in public accounting and I was sent out on errands to meet with clients or go do audits or whatever, I would have to fill out an expense reimbursement worksheet. And that worksheet just basically asks, it looks like this, and it has well, I'm sure you guys have seen it, where it says expense, worksheet, and it'll ask, date of your expense, cost, purpose, right? Miles, and so just detail about each expense, whatever that may be. And you basically complete this, 2, 5, 21. I drove 30 miles to see client. And I present this to my employer, and my employer will reimburse me at 50 cents a mile or 55 cents a mile, whatever it is, and reimburse me for it. And that's what we call an accountable plan. Only then does that become a tax-free reimbursement. So what ends up happening is the corp pays me money, right? Here I am with my greedy hand, and the corp is paying me money. Here's the corp. I pocket that money. The corp gets the deduction, and I receive a tax-free reimbursement. Beautiful world. Everything worked out great. The company's happy. I'm happy. Everybody's happy. So now, for this to happen, it has to be under the accountable plan. And the accountable plan just states very simply that you have to produce an accounting in about 30 to 60 days after the expense. If you don't do it within 30 to 60 days of the expense, it doesn't fall under the accountable plan rules. And then technically, you're not allowed to receive the reimbursement. The other situation is if your employer, which could be your business, your corporation is your employer as well, right? So if your corporation just blindly gives you $200 and says, I don't care about any expenses, Greg, just here's $200 allowance, and I'm not talking about an IRS table allowance for meals, travel. I'm talking about just here's $200, I don't care about anything, here's $200. That is now what we call a non-accountable plan. And then this now becomes taxable to Greg. And Greg is crying because Greg does not want to pay tax. Neither does Greg's clients. So we want to make sure that things are going through an accountable plan. All right. So whenever we have a corp, an S corp, what we are doing is we're reimbursing. And these reimbursements can be for anything, really. It can be for the auto. It can be for the home office. It can be for your cell. It can be for travel and lodging, and so on and so forth, right? The most common ones that we set up here in the office would be home and auto, all right? And again, what we're trying to do is we're trying to figure out, based off of our clients' needs, situations, what is the best route of reimbursement under which type of plan. If it's for auto, and we know that we have a consultant that might be using his vehicle, like for example, a real estate agent, 60% of the time, and it's a leased vehicle, we would have this discussion with the client and explain which method might produce bigger deductions under their situation, what are the tax implications of both methods, and then ultimately leave it up to the client to decide which way they want to reimburse. And reimbursements typically go through payroll. Now remember what I said. If you're an owner of a corp or an S corp, you're typically getting a salary, a W-2. So no different than when you're an employee and you were working for your employer and you sent in your expense worksheet, you would typically get that reimbursement not out of a tin can, but you would get it with your payroll. Some companies, smaller companies, definitely had a little, what do we call that, petty cash, a lockbox, and they would reimburse out of it. That can happen too, that's normal. But most companies would just, bigger companies reimburse everything through payroll. You get your paycheck, you also get your reimbursements. And part of your reimbursements can be auto, home office, especially home office now with so many people working at home. That became very common. Everybody's at home working. That's a really great way of receiving your reimbursement for your expenses. Back in the day, before 2018, we had unreimbursed employee expenses, and we actually had some options. So let's talk about this for a quick sec. And it doesn't apply anymore. It doesn't apply, but I'll touch upon it anyway. So before 2018, you had really, if you didn't get reimbursed directly from your corp, here's the corp. If you didn't get reimbursed, then you can take on your 1040 on your personal return, you used to be able to take it as a Schedule A unreimbursed employee expense, which was subject to 2% limitation of AGI and AMT, and you had to itemize, blah, blah, blah. So most people didn't benefit from this, and they lost, if they did benefit, they lost it to, limitations. So even back then, we always tried to put through the expenses through the corporation, because, and it doesn't matter if you don't own your corp. If your employer sends you for some sort of errand, you want to make sure that you're getting reimbursed, whether that's home office, whether you're using your personal cell, whether it's an auto, whether you went out of town and did some sort of client out of town trip. Yeah, you still wanted to make sure that you're getting reimbursed from the corporation. It's tax-free as long as it's under that accountable plan. So that's in a nutshell the way it works for reimbursements. And so you have basically once you set up your entity and you're running with your entity, you want to do once a month you submit your expenses to yourself in essence, either with a worksheet from ILIQ or some other way where an accountant's helping you figure out what your home office deduction is, and then you continually proceed to reimburse yourself this way. And this way you're going to avoid taxation and pull money out of your corporation and basically audit-proof your deductions. We also offer accountable plan, what are they called, like a internal document for the business that we put into place that we recommend that our clients get notarized, that basically spells everything out, that it becomes a formal plan the way it should be. And this way it can never be challenged under audit if that accountable plan is notarized, because then no auditor can look at it and say, well, you've been reimbursing yourself all this time and you ran out and just put this plan into place. You'll say, no, because I got it notarized. And you can tell that it was notarized at such date. So this plan has been around and in existence according to the law. I did everything correctly and I'm reimbursing myself through the business under an accountable plan, and therefore everything's been done properly. And that's typically how that rolls. Now, as far as owning the vehicle, like I said, you personally own the vehicle. So the next question typically is, well, do we put the vehicle under the business name? Does that make everything easier? No, you don't. You don't want to take your personally owned vehicle and move it into the business. No, you do not want to do that. Why? Well, simply because of legal exposure. And again, I'm not an attorney, so I can't advise you, but it doesn't take a genius to figure that one out, that if you're moving another asset into your business, that thing's up for grabs if anything ever goes wrong. So that's just more exposure. Then, as we said, there's tax consequences. What happens if you stop using the business less than 50%? This is awful. If you started using less than 50% for business use, you're going to have tax consequences. If you're using it for personal use, 10%, I don't care, 5%, I don't care, that has tax consequences. That becomes taxable income to you, right? So these reasons is why you typically don't want to put it into your business. Also, insurance would cost more money because now it's a commercial vehicle. So if you're just like a real estate agent, why in the world would you want to go through all this and put your vehicle into the business and create all these potential issues for yourself? You wouldn't want to do that. Again, this is assuming a corporate type of structure. I'm not talking about an LLC, a single member LLC. Once you have a corporation, we're in a different ballgame. So that's basically huge reasons why you don't want to move it into your personally owned vehicle into the business name and title it to the business and put the registration and all that under the business it's just going to create a lot more work, a lot more exposure, completely unnecessarily. You're going to be way better off just getting into your car, clocking in that mile IQ and taking your standard miles and just move on with your day and not even have to worry about any of this other stuff. All right, one more thing I want to talk about besides all that would obviously be gosh, I forgot what I wanted to talk about next. Yeah, home office. So what type of travel is typically okay? So if I'm here in my home, and this is my happy home, all right, with my little palm tree, because now I live in Florida. And this is probably the worst palm tree you guys have ever seen, but I tried my best. And I have a dog, and that's probably him running and messing up my yard, and he has ears. So if I'm here and my office, which is really glitzy, glamoury, and looks like a castle. No, I'm just kidding, guys. It has a big Freyman CPA sign, right? Red carpet, my limo. No, I'm just kidding. I'm just kidding. All right, so for me, coming here and going there is not deductible. I would love to take this deduction. So if I want to drive my car, and I really need to take some more lessons on my art. So if I'm driving my car over to work, to and from work, not deductible. Not deductible. IRS says no. That's considered commuting. Then everybody would do that. Have you ever heard of anybody commuting to work and getting a write-off? No. There are, obviously, I'm going to show off a little bit my knowledge. Yes, in the city, your employer can, get you some transit passes, and actually there's tax provisions that pay for employees bicycle parking and regular parking for cities. And actually, New York City actually enforces employers to provide for transit passes, which is a tax strategy. I'm not going to talk about it, but it's actually an enforced policy for New York City. If you have over a certain amount of employees, that does not apply for many people, so forget it. But yeah, so commuting to and from work's not a deduction, but guess what is? If my home has a home office, the IRS says you can take it. As long as I meet certain criteria here for the home office, and I'm not going to go into that, I'll do a separate video on that. But typically when I have a home office, then commuting to and from my regular place of business becomes deductible. And that's really a great way to get a little extra deduction. Depending on how far your commute is, it might do something for you, it might not. Me personally, I can work from home. I can set up an office at home that would be a qualifying home office for tax purposes. It just isn't worth it. I live so close to my office that the deduction would prove to be more of a burden for me than it actually would be worth it for me because of my time involvement to keep up with all the accounting to make this actually worthwhile. So, but for many people, this could be 20 miles. I have clients that drive all the way to, 2 hours a day to commute. So for them, it's a pretty decent deduction. Other than that, if you're traveling out of town, obviously that becomes okay. If I drive to work and then from work I drive to a client, that's okay. And then I believe from a client to home might be okay. I don't remember exactly. And that's something that MileIQ is great at. It does provide that information. It has a lot of articles on how to how to understand this deduction, the travel. And I'd also say that you're basically dealing with, besides this, you can also, besides MileIQ, you can also look into a travel publication. I believe it's 463. Ange, am I correct? Is travel 463? So if you Google IRS publication, double check me. I believe it would be publication 463. Now remember, folks, publications are there to inform the public. They're not exactly tax law. IRS publication 463. Let's see if my memory serves me. Yep, it's a travel, gift, and car expenses. Yeah, so that's the travel one. I got that one right, and kudos for me. So anyway, that's basically the gist. So just to sum it up, you know, two types of methods of accounting for your vehicle: actual, standard miles. Typically, you don't need to reimburse if you're organized as a single member LLC or you're sole proprietor. Everything gets more complicated when you're set up as a corporation. We always said that from the very beginning, and that's a formality we all have to go through, and that would be an accountable plan where you're reimbursing yourself either for home office or the automobile. And other than that, we gave you the pros and cons of both methods. And again, we're kind of leaning always more towards a simplified method of accounting for your vehicle because it will produce typically better results for most people, not for everybody. And I think that's pretty much it. We talked about, you know, placing the vehicle into the business name, which is not always the best idea, especially if the usage of the vehicle might drop below 50%, or even if it's 80% business use, it's not a great idea. We touched upon the home office and some strategies there, and that's the vehicle in a nutshell. So I hope you guys enjoyed this segment brought to you by Freyman CPA, where remember our motto, all day, every day, what do we do best here, Ange? Drawing a blank. She's drawing a blank. All right, I'll say it for you. Your success is our success here at Freyman CPA all day.
That's right, every day.
Every day.